Happy Tuesday, everybody. It's Austin at Homeowners Financial. And of course, you're hearing so much about what's going on in the banking system. And I thought it'd be really relevant today to talk about how that's correlating to. So typically we have the interest rates to correlate to the 10-year treasury bond. As that goes up, rates go up. As it goes down, rates go down. And we're talking about the yield there, right? So what you saw in the past couple of days is that the 10-year treasury went 3.9 down to 3.5. It's coming up to about 3.6 today. And so far rates are flat. Now, typically a 3.9 to a 3.5 move means rates are going to drop by like over half a point, but they didn't. Why? If there's a lot of concern about having run on banks, there is less money to lend. What does that actually mean? So banks are required to have reserves on hand, right? So if they lend out $1 million, they need, say, $150,000 capped so that they're able to have the reserve requirement by the federal government, because banks make money based on lending money. I don't know if it's actually 15%, depends on the size of the bank, depends on the type of deposits. But anyway, that's the concept. The concept is, yes, you're lending money out. However, you're taking that money from your people that are being deposited with you. You're lending it out to make money, and that's how your deposits are actually generated a rate of return, okay? So that's how the banking system works. Now, if 500 people come in and say, hey, I want my $250 guaranteed by the FDIC back today, I need to go make some money out of it, I need to liquidate my assets, that is a run on the bank where everyone's taking their money out. Well, if they've lent out the $1 million and they only have the 150, they can't necessarily satisfy every that. There's also a level of mortgages that as a mortgage lender, there's a certain amount of cash you need to have on hand depending on how big the size of your books are. So that's a very long-winded way of saying the rates are not completely dropping, because if these folks that are lending money have to have cash on hand for their deposit, whether it is Redwood Trust or it's a hedge fund and people want to liquidate their, whether it's CIT Bank where they want to actually come in and liquidate their, whatever type of institution is, if they're going to have more and more money on hand because they're worried that people are going to ask for it back, then there's less that they're going to lend out. Therefore, they're going to lend that at a higher interest rate because they're going to make it more enticing to lend that money versus the risk reward of keeping it on hand. There's a little insight to the banking system for you. It's Austin at Homeowners Financial. Let me know what I can do to help you and anyone else. Make it a great day.